So my audience ranges on average from the age of 24 to 44 years old as the bulk of my audience. I believe at this point in time, somewhere between 60 and 70% of you viewing this video are typically somewhere in the range of 24 to 44. Now, obviously, I have a reasonable base of people who are under 24 and a reasonable base of people over 44. There's value in this video regardless if you fall in a different age spectrum. But saying that more than 50% of you tend to be between the ages of 24 and 44 years old, that means that you're still in the heart of your working and investing years. In this video, I want to cover what the framework should look like for you investing. And we're going to talk about this from a broader perspective when it comes to investing in the stock market, using banking products, real estate investing, more structurally around what your investment strategy should look like, what is your risk tolerance and other things, what it should look like to help you have a more decisive path to investing so you can be more successful and sustainable. So we're going to talk about all of that in this video. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel, uploading content on a daily basis to help you customize your personal blueprint for prosperity. So many of you go through the majority of your working years and investing years, are starting to go through those years without a lot of guidance around investing. You get marketed investing all the time. You have many different ads, you have many different YouTube channels. If you're on Instagram and Facebook, you see it all over the place. If you are already kind of around that kind of content, you're being targeted with plenty of marketing around various investment strategies. You're also taught from mainstream media, mainstream culture that you need to be investing. You're given a little cookie cutter examples of what investing should look like. And many of you are either sitting on the sidelines, not investing at all and taking advantage of you. And some of you are trying, but you don't really have a strong framework. And there's maybe a small niche of you that are actually working with professionals or doing the due diligence yourself. And shout out to you if you fall in that category. In this video, I want to actually give you one of a one-on-one consultation type style breakdown on how you should build out your profile for investing and what it should be predicated on so you can have much better results over time. One of the most important components of structuring your investments is number one is your current age. Your current age is a huge determinant of how you should be structuring your investing, possibly what you should be investing in, and your time horizon. That leads me to your next important component, which is your time horizon. What are you investing for? It is important to understand that investing is different than saving. Saving is risk-free. Generally speaking, when you're saving risk-free. You're not taking risk with that money. You are preserving capital. You're preserving principal. You're not investing. And I think a lot of confusion is around that in itself, because the first thing people say when you start a 401k or an IRA is saving. It's absolutely not saving. Let's clarify that right now. Please get that out of your mind. Please stop listening to people who are saying that, because it's one of those nuances that just triggers your brain to thinking about it the wrong way. You're not saving in a 401k because your savings doesn't take a 10% dip if something happens in the economy. The savings should not be at risk when you are in a certain financial product, okay? So let's get that out of the way. Your investment time horizon is very important, because what are you investing for? Are you investing your money to gain some extra earnings to buy a house in a few years? Are you investing for retirement 10, 20, 30 years out? Are you investing to start a business in the next handful of years? What is your time horizon? Your current age, your time horizon. The next thing you need to figure out is, what are your goals? What is it you're investing for? Is it the entire future? Is it your kids' college fund? Is it a car for your kids? Is it is it starting a business? Is it buying real estate? What are you investing for? Is it vacation, a wedding? What are you investing for, and what's the timeline for that? What's the target number for that? So what are you getting when you put these three parameters in place? Your current age, your time horizon, and what's your end goal? What it does is it allows you to figure out how much you need to be putting into that investment. It allows you to figure out what investment vehicle you should probably get in. And it allows you to figure out what risk tolerance you need to be prepared to have to meet that goal. if you are, you know, somewhere between 18 and 25 years old and you're just starting out, your financial career, and you're just starting out your working career, and you are just trying to start now. You're one of these ultra responsible people that are trying to start saving or investing now for your retirement at 50, 60, or 70 years old, whatever target range you have, but decades out. Then, for instance, breaking it down by the fact that you're only, between 18 and 25, and that your end goal is just right now focusing on retirement decades in the future, that means your time horizon is multiple decades out. You can be conservative and get into a very conservative investment vehicle. You can put moderate contributions to it and just let it snowball over time, taking minimal, low-level risk and let it snowball over time, because you have the biggest factor in investing in your favor, which is time. So you can get moderate 4, 5, 6, 7% returns, or returns that just meet or exceed inflation, and a low fee product, putting hundreds of dollars a month to the side for 20, 30, or 40 years, and you'll be in pretty good shape at retirement if you do that. Now, on the other side of that, you may be saying, I'm trying to save 30% down for a home purchase, and I have 3 years to do that. And in that scenario, now you only have 3 years. You're trying to go from 0 to 30% down. We'll say maybe on a $300,000 house, which is, $90,000 if I'm not mistaken. So that's a pretty significant difference. It's a big deal. Now we're talking about having to be quite aggressive, in either contributions or earnings, like return on investment, or a combination of the two, because you have a very short window of time to put a lot of money together. So you see how this starts to shape out, understanding where you currently are, understanding the kind of time horizon and your end goal. This little melting pot of framework puts in perspective how aggressive I need to be. Well, how long, you know what I'm saying? What strong suits I need to be, to have in place, and what do I need to be prepared for in order to reach this goal? So what I recommend when you start thinking about, okay, I know my time horizon, I know I need to either be aggressive, I can be moderate, or I can take it slow. That's when you start to determine what type of products you need to be in. If you have a really long window of time, and we're talking decades, then you can go into an extremely comfortable, relaxed ETF or mutual fund. You can sometimes even get away with, the rates are going to fluctuate based on the economy. But sometimes you could just be saving in a CD or a money market if you can continue to get decent rates in those products and be okay, depending on inflation and purchasing power, of course. Down the line, you can take a very low risk approach because you have a ton of time to put that capital up. As long as it's compounding over time and something moderate and steady, you got a long way to go. When you start talking about 3, 5, 7 year time horizons, that's a different beast depending on how much money you need. If you got kids that you're trying to put through college, or at least put together a reasonable fund of money for them to, have contributing to their college, and maybe you got 5 or 7 years to get that done, that's a different beast. If you, maybe trying to put up 15, 20, 25 or $30,000 at least towards their college, and you're starting from zero. And that means, you have to break that calculation out. Okay, well, I have 5 years to, put together X amount of dollars. I need to contribute this much and it needs to get this kind of return. Or you need to figure out what you can afford to contribute sustainably, and then figure out what interest rate return on that money you get or need to get in order to reach that target goal in the end. Does that make sense? So I'm gonna recap that real quick. Once you figure out your time horizon, then you need to figure out what contribution level you can afford to consistently put into that investment. And then you can start to figure out the return on that investment you need to reach that target goal over that amount of time. You see how that calculation comes together? When you think about something like real estate investing, this is more of a scenario where you need to say, okay, how much real estate or what kind of return on a real estate do I need for the time horizon I have in mind? If it's retirement, again, if it's, buying a second property or putting some lump sum together for some, wedding at some point, whatever that event is or that landmark is for you, and you're trying real estate, and we're assuming you're doing buy and hold real estate, that's more of an investing strategy versus fix and flip and being more transactional. It's not necessarily an investing, but, it kind of gets thrown in that bucket. You need to start figuring out, okay, well, I need, $40,000 for said event coming up, in 5 or 7 years or 10 years. And how much property, how much rental income do I need? Real estate is kind of nice because you also get tax benefits that can play into that amount of money. You can get appreciation. You might be able to cash out, refi on that property down the line closer to it and take the money out that way. You're not just relying on just the income and just the immediate return on that rental income or that investment, if that makes sense. Versus something like stocks, 401ks, IRAs, you're literally kind of stuck between just the growth maybe of that product and largely the spin-off, the return on that product. Real estate gives you multiple ways to get access to growth. So hopefully this is starting to put a framework together where you start to understand when you start talking about investing, whether it be the stock market, real estate, or any other investment strategy, dividend stocks, peer-to-peer lending, there's a plethora of financial tools out there that can help you, grow your money. But a lot of you are chasing the sexy, over-marketed strategy that hits the market. You're running behind whatever's available, or some of you are in the other camp. You're disciplined when it comes to what's marketed to you, but you struggle with being, too conservative when you maybe need to be doing more, or you're doing a too conventional route where you need to be getting a little bit more creative. So this is going to give you the framework that anybody can apply. It gives you the equations and the framework to know how realistic is it for me to reach my goal versus me just arbitrarily starting to invest and just hoping it snowballs into some goose egg and works for me when I get to that deadline. You don't want to do that. You need a plan. You need a strategy. And that strategy is going to come from understanding exactly where you are in age and financially what your starting point is, what the end goal is. And between those two, you can start to figure out your timeline, contributions needed, returns needed. Hopefully this makes sense. I want you guys to be set up for success. I don't care what age bracket you're in. If you're still out here running this race, then it's not over. And if you can figure out, if you have a plan, if you have a strategy in place based on your specific needs, this is why another reason you don't need to be following too much marketing. It's good to know what products and strategies are out there, but you need to still understand your personal circumstances, because that investment strategy that could be marketing might fit great for somebody with a 10, 15, or 20-year time horizon, but might be a bit of a struggle for somebody with a 3 to 5 year time horizon. Or you have a 30-year time horizon and what's being marketed to you has a risk tolerance of somebody trying to get that investment return in 3 to 5 years. It's too high of a risk for you. It depends. It's very specific. That's why there's so many products, and that's why the financial services industry is always so steady, because that type of subjectivity requires professional oversight or a lot of homework on your part. I appreciate you guys tuning in. I know this was valuable for you. I want to continue to drop content like this. I actually want y'all to comment down below and let me know where you are at in your investing journey. What's your age? What's some of your target goals? What vehicles are you using? How's it working out for you? How can it improve? Drop it in the comments below. As always, I want y'all to stay focused, stay in motion. I'll see y'all soon.